So today we're talking about the Swiss franc. It's been on an absolute tear, really flexing its muscles against the US dollar. Let's unpack what's going on here. All right, let's get right into it. The big news, the US dollar just broke below the 0.78 level against the Swiss franc. Now, you might hear that and think, okay, a number, but for anyone watching the currency markets, this is huge. I mean, this level was like a brick wall for months. The fact that it just got smashed through, well, that tells us something big is shifting under the surface. So here's how we're going to break this down. First, we'll look at this big upward move by the franc. Then, we'll get into what's actually driving it. After that, we'll zoom in on the shrinking rate gap between the US and Switzerland. That's super important. Then, we'll talk strategy. And finally, we'll cover the risks you need to watch out for. And yeah, when we say a decisive break, we really mean it. This isn't just some small daily wiggle. The dollar tried again and again to stay above that 0.78 line and just couldn't. It's like a dam breaking. This shows some serious momentum, and honestly, it could open the floodgates for the franc to get even stronger. So what's behind all this? What's the engine driving this big move? Well, what's so interesting here is that it's not just one thing. It's more like a perfect storm, a powerful push from three different directions, all at the same time. Okay, so what are they? First up, the US dollar is just, well, it's weak right now, pretty much against everything. Second, and this might surprise you, Swiss real interest rates are actually really high. And third, people are looking for safety, and they're buying up what are called safe haven assets. You put those three together, and boom, you've got rocket fuel for the Swiss franc. Okay, hang on. I mentioned real interest rates. Let's just quickly define what that means, because it's super important. It's not the interest rate you see on a billboard. You have to take that rate and then subtract inflation. What's left is the real return, what your money is actually earning. And that number is what really matters for the France appeal. And here's the crazy part. Switzerland's main interest rate is basically zero, but their inflation is also near zero. So when you do the math, the real interest rate is actually pretty high and positive. This means holding Swiss francs is actually profitable in real terms, and that gives investors a huge incentive to own it. All right, and that third driver, it's the classic flight to safety. Think about it. We've had this massive run in AI stocks. Some investors are now thinking, okay, maybe it's time to cash in some chips. But where do you put that money? You look for a safe port in a storm. And for decades, the Swiss franc has been one of the safest ports around. It's a tried and true move, and we're seeing it happen again right now. Okay, so we've got a weak dollar, high Swiss real rates, and a flight to safety. But all of that is kind of leading up to the main event. The single biggest reason for this whole trend, you ask? It all comes down to the simple fact that the US and Swiss central banks are walking in completely opposite directions. Here's the deal in a nutshell. The US Fed, they're basically telling everyone they're going to keep cutting interest rates. The Swiss National Bank, on the other hand, is expected to just sit tight. So think about it. Every single time the Fed cuts rates, that gap, that advantage the dollar used to have because of its higher rates, just shrinks. It's getting smaller and smaller. And this chart shows it perfectly. See the US bar? It's heading down. The Swiss bar? Holding firm. That gap between them is the whole story. For years, that gap made holding dollars a no-brainer. But now it's closing, and it's closing fast. And look, money is simple. It goes where it's treated best, where it gets the highest return. So as that US advantage disappears, the pressure on the dollar to fall against the franc just keeps building. Okay, so we've laid out the why. The trend looks pretty clear, right? So the next logical question is, what does this mean for the future? Where does the road lead from here? Now, to get into strategy, we first have to talk about a classic move called the carry trade. It's pretty simple. For years, big investors would borrow money in Swiss francs because the interest rate was super low, and then they'd invest that money in currencies that paid a higher rate. Easy profit, right? Well, not anymore. The francs sudden strength has completely upended that entire playbook. So, given everything we've talked about, the forecast, at least for the short term, is for this downtrend to keep going. The target everyone's watching for the next 3 months or so is that 0.75 level. And if we look out even further, say over the next year, the expectation is more of the same. The dollar is projected to weaken even more, potentially hitting that 0.74 mark. And this brings us back to that carry trade. Here's the key takeaway, especially if you're a trader. If you put all your eggs in one basket and only borrowed Swiss francs, you likely got crushed. Why? Because even though the interest was cheap, The franc itself got so much stronger that when it came time to pay back your loan, it cost you a fortune. It completely wiped out any gains. This is a perfect example of why the smarter strategies involve diversifying, spreading that risk across a bunch of different currencies. But it's never a one-way street. No forecast is guaranteed. There are always things that can go wrong. So, what could actually stop this train? What could derail this whole forecast and send the franc moving in the other direction? Well, it really comes down to two major risks. And what's kind of ironic is that the biggest threat to a strong Swiss franc is the Swiss National Bank itself. First, there's what's called direct intervention. See, if the franc gets too strong, it's actually bad for Swiss companies that sell their stuff abroad. So the central bank could just jump into the market and start selling francs to push the price down. The second big risk? They could bring back negative interest rates. Basically, they'd charge you for holding francs, which would obviously make a lot of people want to sell them. So all of this leaves us with one big final question to think about. In a world where the big players like the US Fed are cutting rates while Switzerland is standing its ground, is the Swiss franc moving beyond just being one of the safe havens? Could it be on its way to becoming the ultimate safe haven? That's the real story to watch going forward.